One of the most important things I would emphasize is maybe the concept of two-sided risks has really come into focus. I would say more over the past few weeks. It actually started before the U.S.-China trade pause tensions of a couple of weeks ago. But I think when we're talking to investors, there's also a focus on what could go right. And I think the fact pattern over the past few days was case in point. Friday we left, it was a bit of a risk on tone. We came in yesterday, quite a risk on tone. Corporates, investors alike don't want to be caught off sides. And so I think there's just a recognition of the two-sided risks. We are actually comfortable selectively moving down in credit quality. That's a view that we've had for a while. And I think that is actually, for an investor that is taking a bit of a longer term perspective, compounding these spreads and yields, I think it's a pretty attractive opportunity.
So I'm looking at just at the IN Go function, the Bloomberg Index browser, just kind of looking at where things are going in fixed income here. Corporate high yield has been like the best performer, 2.46% total return year to date.
Yep.
I mean, again, it seems like the market's willing to take credit risk.
Yes, and I think it's notable on a few fronts. High yield outperforming IG in an environment like this where there are some residual concerns about growth downside risks and also an expectation that we are slowing from an above trend pace. I think that's really twofold, Paul. One is you're still able to capture a pretty attractive incremental spread in high yield. You don't have as much duration exposure. So when treasury yields sell off, you're less impacted in the high yield space. And then two, importantly, fundamentals between a lot of these pockets of the market have converged. Actually, if you look at leverage for double Bs, which is the high end of high yield, and leverage for triple Bs, the low end of investment grade, they're actually the same. You can see that on the Bloomberg terminal. So you're not giving up a ton in credit quality to move down, or not giving up a ton in fundamental quality to move down in credit quality, and we like that.
See how she pitched the Bloomberg terminal?
Yeah.
Let's have her back.
She knows who listens here. So what's the thought here about this Federal Reserve? We had a guest on just earlier. Doesn't think there's going to be a rate cut this year.
It seems like the Fed officials are priming the market to expect really nothing until September at the earliest.
Okay.
That the commentary from the past, I would say, several days suggests that. I think that makes sense. If you remove some of the downside risks to growth, so we take kind of that left tail recessionary case off the table, which we believe we've done, and really we weren't expecting a recession anyway, and you have above target inflation, the urgency and the impetus for the Fed to act preemptively, we think is pretty low.